Afternoon and welcome to today's session on Untapped Sources of Finance for Entrepreneurs. I am Prasanna, co-host of the event today. Let me introduce today's presenter, Mr. Sunish Shah, and narrator, Mr. Vishal Shah. Mr. Sunish is Managing Director at Fund Flow Consultancy Private Limited and Fund Flow Services Private Limited. He is an astute finance professional having 25 plus years of experience in finance planning, fundraise, and financial management. Mr. Sunish embarked on his professional journey with a solid foundation in mechanical engineering, graduating in 1994. His pursuit of knowledge led him to acquire a postgraduate diploma in business administration marketing from ICFI Business School, complemented by achieving the esteemed Chartered Finance Analyst designation in the same year. He contributed his knowledge and capabilities to Tata Finance Limited and Cholamandalam Investment Finance, to name a few. With a wealth of experience in managing and raising funds for more than 10,000 plus clients, he and his companies have made a substantial impact on the financial landscape. Mr. Shah's dedication to excellence, transparent business practices, and personalized service has gained him the trust and loyalty of numerous satisfied clients. Mr. Vishal Shah, CEO and co-founder of Sinosoft Technology, he is known as seasoned technology stalwart, an inventor of specific patented technologies, a writer, a serial entrepreneur, an investor, and most importantly, a go-to guy for MSMEs. This webinar is specially designed for business owners and entrepreneurs. In this engaging webinar, Mr. Sunish will dwell into the world of untapped sources of finance for entrepreneurs and small business owners. During this session, he will update on conventional sources of finance, non-conventional sources of finance, examples, possible solutions, and practical tips. If you have any questions during this session, kindly write in the question and answer tab in the bottom of your Zoom login. He will take up the questions at the end of the session. Alternatively, in case you want to ask any question in the end of the session, you may please raise your hand. We shall activate your microphone to ask the question. Vishal sir, can you please take it ahead from here?
Yeah, thank you, Prasanna, for our introductions, and thank you, Sunish, for taking out time and attending this webinar and showing your willingness to share knowledge with like-minded entrepreneurs. So, as I see, and as many of us meet again in this kind of series of webinar, most of the times I do all the talking, but this time it is Sunish who is going to do all the talking. So when I was interacting with Sunish, something struck, very, very fast with me. And that was about, he made a statement that most of the entrepreneurs, they always tap the first available source of fund, not the best available source of fund. So that really struck my mind very fast. And I thought that, yes, when I looked into retrospectively my financial behavior, my financial decisions, most of the times I also, tapped the first available source of finance, not the best available source of finance. And that means there could be best available source of finance, which is not the first available source of finance. And that could be an untapped source of finance for business owners. So I thought that let's have a webinar on this and let's invite the entrepreneurs to this discussion. So that is a gist of today's webinar, and Sunish is a very illustrious professional, and he is going to tell everything about finance to us. So over to you, Sunish. I request you to introduce the session, as well as we will run a small poll at the end of every slide just to understand the feedback of our audience, basically. So over to you, Sunish. After this slide, please call the poll also.
Thank you, Vishal, and thank you, Prasanna, for a lovely introduction. Today, the topic which I'm going to use or discuss is actually everybody needs to understand this topic. As Vishal said, the people generally go for the first available source of finance, not the best available source of finance. I will slightly change the sentence. People go for the first available source of finance and do not go for the optimum available source of finance. The reason is every time the best or the cheapest fund is not suitable to us or not possible for us. Everybody wants Sasta Sundar Tikau, but sometimes we need to fit our basic requirement to the product and then choose that. So that is the reason why we need to understand this topic very seriously and implement in every stage of our businesses. So as I understand, Zanamir, can we go for the next slide, please?
Yeah, before that, please launch the poll so at least we get to know our audience well.
Okay.
So the question is, which of the following profiles fit you the best? So we, Sunish and me, could know more about that, So So as we see the results on the screen, 14% of the audience are self-employed professionals, 29% are small business owner, 43% are small and medium enterprise owners, and 14% are financial management professionals. So, Sunish, we have a very, very relevant audience today. So, I think I'm hoping that this discussion is going to be very, very exciting and insightful. Over to you, Sunish. I'm changing the slide for you.
Thank you. Thank you, Vishal. When we will be discussing about the various sources of finance, we will be talking about why we should use this finance or what kind of thought process we should have while deciding to going for such finance. Because finance is available for many sources. There are various pros and cons of every kind of finance. So we should better have a thought process to find out which is the best fit for our industry, our business, our profile, and our risk appetite. Yeah, sure. Basically, first and foremost, everybody thinks about what we should go for is our own fund. I can borrow it from my father. I can borrow it from my friend. I can have my family who will contribute to my business. And then that is how we start. This is generally is the starting point of any business where we invest our own funds, either by diluting our investments or by borrowing from friends and relatives or from family. Basically, that is the fund which we have actually saved for our personal use, which we take out from that and then we use it for business. As far as I understand, that is the cheapest source of finance, but there are risks associated with it. When you put every penny what you have in your business, so whenever you have got an up and down, you do not have any funds left out with you. So when you decide to shell out your personal fund, you should always keep some reserve funds for your personal use before completely investing into the business. I'll just come back to this by an example. Let's say you have 1 crore of rupee totally as an investment which you can invest in your business or you can manage your family requirements. So I will not recommend you to invest 100% of 1 crore rupee to this and then borrow when your personal requirements are. You should decide the mix that what kind of personal liabilities which you may have in next due course, maybe 2 year, maybe 3 year. You put that reserve fund with yourself and remaining fund only you can think of investing into the business. At the same time, you can have the next source of fund which is for the personal use only, which is either through family or friends. Generally, people borrow from either the existing business of the family or existing saving of the family. That is also sometimes not required because every family member are at different stage of life, and sometimes to borrow that fund puts you into different risk profile. At the same time, that fund is generally on-demand fund. The way you demand the fund from somebody in the family or a friend and say, I want, let's say, 50 lakh of rupees for a specific use, and then you invest into business. That means when you have got the money on demand, you need to pay the money on demand, because you can't say that I have taken the money and I'll not give it for the lifetime, or I'll give it on this date. So whenever there's a requirement from the other family member for their requirement, they may call you to repay back. That's on demand, and sometimes the business does not support the immediate withdrawal of that fund. So technically, that fund is easily available without documentation, but the repayment is also very quick sometimes, and that time you need to borrow from wherever possible. That turns out to be very, very costly. So personally speaking, in doing business, we should sometimes take a bridge loan from friends and family, but not huge funds. And when you take it, there has to be very, very clear that how long you are going to use it. So if that fund is available with that family member or a friend for that period, or even for a longer period, then and then you should borrow. At the same time, you have to be very clear in terms of payment and terms of rate of interest. Generally, when you borrow from friends and family, people, because of the social stigma, sometimes do not ask the rate of interest or the time of repayment or a tenor for which you are borrowing. That turns out to be sometimes conflict, sometimes social issue also, when either they expect a higher interest and you cannot pay, or you decided a longer period and they wanted a shorter period. So that goes into a strained relationship. So it is always better to go for a structured financial institution. And financial institution will have various products available, which we'll be discussing in detail, which can suit every industry. So while deciding any funding for the business, we should understand first what is the stage of the business, whether it is a starting of the business or an expansion of the business, or we are borrowing for specific deal or a specific time period, or are we debt financing? Sometimes, let's say when you want to start a business, there are multiple sources available where nowadays where you can borrow from. One, definitely you have to start with your own capital. Then and then your banks and other financial institutions will support you. There are two kinds of institutions. One, which supports you based on your projection. The second, which will support and finance you based on your past history. So sometimes, let's say you have your own business and you want to start a new business, then there are banks who will evaluate your history and give you a fund. Whereas some banks where you can go and give a security, some based on those security and based on your qualifications, sometimes you take out some down payment and you make some payment. So based on this, there are ways to evaluate any kind of source of fund. Let's say, for example, somebody wants to start a new trading business and he does not have any background. Then when he goes to a bank and borrows, the bank will always ask for a history, the reason, everything. At the same time, the security. And if you are a new entrepreneur, probably the rate of interest they may charge is slightly higher. In that process, banks have a industry-specific parameters based on which they calculate what you can do and how you can do. So technically, there are different kind of loans available for traders, different kind of loan available for manufacturers. Every stage of process, there are different kind of loan available. Let's say we will talk about a manufacturing unit and you want to start a manufacturing unit. So first of all, there will be a need to acquire the factory. For factory, you need to acquire the land and construction. So there are parameters through which you can borrow for a land, and there are parameters through which you can borrow for a factory construction. Once that is done, there are ways to borrow for the machinery. Once your factory is up and start running, then you need to you need the funds to manage your working capital. When you need to manage working capital, there are ways to calculate it and then invest into working capital. So basically, people go to a bank and say, I want the total requirement is this much, and my supporting system is this much, which I can take out. Based on which bank will decide how much you can invest, how much bank can supply as a loan. Now you need to work out on your budget and whether that total amount suits your total requirement starting from land, construction, machinery and working capital or not. Most of the time entrepreneurs, because they're very passionate about their business idea and what they want to do, they try to be very aggressive. Let's say they have a fund of 50 lakhs of rupees and banks give them only 1.5 crore of rupee based on that, which is 75% of the total project, which turns out to be 2 crore, which may be an investment in land, construction and machinery. They don't calculate the working capital requirement, and that's where they make mistake. So technically, when you start a project, you need to evaluate your total fund planning plus contingency planning. This contingency planning is very, very important because your project may go shoot on time period or some cost may go up. And this has happened to a lot of entrepreneurs who have started their projects in 2019 mid, and the corona came and the delay started and the interest issues and the cost of freight and everything gone up, and they had to borrow again. That may sometimes put you into a problem. This is the peculiar situation which comes for an industry which is targeting a turnover of 10-15 crore of rupee a year. The reason is most of the time these decisions are taken by an accountant plus a technocrat owner. A technocrat owner is a very thorough in his business, in his understanding of his product and other things. Whereas the accountant is generally an upgraded guy from a general data entry accounting system, probably some kind of auditing basic work, but he is not very, very clear on finance. So generally they borrow from the first available source. First available source means they go to a known person or they go to a known bank or an existing bank and they propose something. They may not explore the other possible suitable things there for their business, and because of which sometimes they end up making a mistake. And when they end up making mistake, after putting all your money into your investment business, you end up with some kind of shortages in terms of fund availability. So you need to have the alternative source available with you. So basically, when you want to start the business, you need to explore wherever the funds are required, which may suit. So the funds required for your land and building should be a very long-term fund because the life of that will be very long. The machinery will be have a life. So let's say your machinery has 5 years of life and you're borrowing for that machine is for 10 years. That means after the life of machine, your loan is pending, and you need to pay the installment where your machine is not working. Sometimes you take a loan which is a very short loan, and your machine is not capable to generate that much revenue per month. That means you'll start defaulting in because your installment will come, whereas your machine is not generated. So every time when you borrow for a whatever specific reason for business, you need to understand the kind of reason why you are borrowing and whether that life of that borrowing compared to a tenor of the borrowing is matching. It cannot match exactly, but it should match near. So you should borrow for long-term fund for a long-term requirement and a short-term fund for a short-term requirement. Just an example, sometimes people buy land by taking a cash from relative, and then that fund is locked in a land, and when they have to repay from a working capital of a business, which leads to a major cash flow issues in the running of the business. So you always decide what you are borrowing, for what terms, and against what purpose. So this is at the time of starting the business. Let's say you want to do an expansion and your current business is already running. That means you are planning an expansion. For an expansion, you need to understand two sources before you go to a bank. One, how much you can take out without affecting the current business. Means you may have working capital available which you take out and put it into a land for a new plant, which is going to affect your business. So basically, you need to understand how much you are shell out without affecting the day-to-day transaction of your business. So once you take out that money, you should understand this business for some time that it is not affected. Then and then you should go for the expansion. And based on that, how much you can take out and how much you can take from bank, based on your past history, your balance sheet, your profitability, your cash flows, and your other assets. Bank will give you a calculation that how much I can pay. You make a total of it, then you decide how much your project requires, whether that requirement is meeting your new expansion project or not. Generally, people do a haphazard planning by putting their own money to start the project and wait for a bank fund. And then they realize that that current business, whatever they have taken money from, starts suffering. So it is difficult for them to get money from the bank. If that happens, you will lose your current business also, and your new project will also suffer. So my suggestion is understand the project, make a budget, then you avail your own fund by taking out from your business or from your saving, then decide the contingency. If you need to take out more, is it available? And after that, your business is running and up and running or not. If not, you should decide the other source of fund before going for your project. Then the third stage which comes is a short-term deal management. Sometimes you get a contract, you get a deal, or probably some seasons are approaching, like Diwali season is approaching, and before that you need to stock. That also depends on the seasonality of your business. So people tend to borrow short term for those period of time to just boost the volume, and after some time that borrowing is lying idle. So in that period, if it is for a specific purpose, wherever you go and borrow from a bank, that time you need to understand how long you're borrowing for. So many times when we suggest the customer, let's say he got a tender and he needs funds, but at the same time he has an asset on which he borrows, which can be available at the rate of 8, 9, 10, 11%. But that is for period of 10 years, and there will be a lock-in period of 3 years. Whereas there are short-term business loan available at the rate of 16%, but you can repay in 12 months. And your tender working period will be also 12 months or 18 months or 6 months. Then you should borrow for a short term at a higher rate, but still your cash flow terms wise, you will make profit. So we need to understand for what we are borrowing for. So for a short-term requirement, you should borrow either through a short-term loan or an overdraft loan, which is also available through a bank. And all those the loan should match your requirement. Otherwise, for reducing just your interest rate and going for a lower interest rate, sometimes you end up paying for a longer tenor, and that longer tenor payment actually will be very, very costly affair for you. The most important stage of business where you borrow is for debt financing or debt repayment. Many a times customer tend to borrow, or a businessman tend to borrow to repay the current loan. That means technically you are not having a positive reason to buy, but you are having a negative reason just to buy time. In this case, you need to understand what loans you are repaying. If it is a higher rate of interest loan and you are borrowing at a lower rate, then it is still advisable. Otherwise, you need to restructure your business before deciding for a borrowing. For all these kind of loans, there are products available with various banks, public sector banks, and non-banking financial institute. You need to understand exactly how long you want to borrow, for what purpose you borrow. Means you starting the business, expansion, specific project for a shorter term, or debt restructuring or debt financing. If you are going for a debt restructuring, it is advisable to borrow new things. If you are going for a debt servicing, then we do not advise to borrow, but we ask you to restructure based on whatever assets and liability you have, so that your business can come back into profitable. Otherwise, there will be a debt trap. This basically is coming from an institution, which is bank, NBFC, where it is not on demand but on commitment. I describe this: bank will never come to you on a Diwali day and say, Sunish, I have given you a 2 crore rupee loan, I require that back and you give me 2 crore if I am paying my installment on time. But bank on a starting date will always define the rate of interest, a tenor, and date of repayment. Means on every 5th, if you make the payment, they will not ask for an extra payment anytime. That means once the deal is done and you are adhering to the rate, the terms of that contract, nobody is going to ask you the money back. If they are not going to ask you the money back, means you are always free to utilize the way you want to, and you can always focus on your business. The moment somebody asks and come back and say, okay, Sunish, there is a Diwali and I need my 50 lakhs of rupees back, which I had given you 6 months back, which is either through a family or a friend. Then what happens is you have already planned something for your Diwali, but you need to take out that money from your business and give it back. So that will make major impact on your business plans. If that happens, your business will suffer. So we need to understand that bank, NBFCs or a public sector bank, when they lend, it is not on demand, but on a scheduled basis. So we have to adhere to it. And this is how we need to plan our borrowing. Any questions up to this? Because these are the two major things, and then we'll be talking about the other small sources of finance which we can avail, but those are available only for a specific kind of people.
Yeah, Sunish, I think we'll take the questions in the last part. We'll first, so people can please make the note if you have any question. We will activate your mic and you can ask the questions. So Sunish, we can go ahead, please.
So after these two things, the new source and new available avenue is through angel investors and venture capitalist companies. Basically, after 2010, when the startup has a lot of people have went into a startups, there are unique ideas which has come through IT and probably productivity management. So there are a lot of technocrats who have started developing the idea, but they do not have fund, but they have their own business case. Where there are people who have money, but they are not having an idea, come and invest. We call them an angel investor who has money, who wants to take a risk on a people who have idea, and then they understand the idea, and based on the idea, they invest. At the same time, when they invest, they probably have two kind of things possible. And sometimes angel investor, after investment, they also take some management role in the business. That can turn out to be positive also, that can turn out to be negative also. If the angel investor comes with the money and the positive frame of mind, with the authority given to the entrepreneur or an innovator to develop the business, sometimes those business can grow multifold because the idea was good and the money came specifically for that. But sometimes when the angel investor comes and he starts giving his idea, the innovator feels that he's not been allowed to do the business in his way, and sometimes because of that issue happens. And so we need to, when we enter into an agreement with angel investors for an idea which is where the innovator or an entrepreneur is very confident about that what kind of terms in terms of money and what kind of terms in terms of day-to-day management and reporting is done has to be very, very clear. And we need to understand that by getting an angel investor's money, and if we go into, or a venture capitalist money, and then we go into a model of burning for a specific period of time, and then start making money from an idea, that will not work out well. Probably most of the people who got PE money or angel investor money or a VC fund at a early stage, they start acquiring customer at a very heavy cost, where they call burning. So they book losses, but they start acquiring to the customer. That strategy has not worked out well in India. Most of the unicorns, probably 90% of them, are still in loss, starting from Byju's to everywhere. If you don't get a next round of funding and you keep on burning, probably you'll at a position that your size is very big and you think that we are too big to fail, but probably because of not getting the next round of funding, you are bound to fail because the size is big and nobody can come and support. And this is what has happened to the most of the investor based on the industry which has changed. So angel investor or a VC will give you a fund at a very, very early stage of your business. Probably at that stage, you only have a strong idea, but you do not have a negotiation power for the terms of terms of valuation. But whenever they give you a valuation, you will be overwhelmed to get that amount because you are desperate to get that fund because you want to put your idea into marketplace. So that you have to come out of the euphoria before exploring this. Let's say if you go and see the Shark Tank, there are only few entrepreneurs who says, we don't want this valuation and we don't want this fund at this terms and condition. Because most of the time, those kind of terms and conditions are going to choke you after some time because those are you have not evaluated at that time of taking money. So that is what I always say. It's a easy money. It may be easy money. It may be free money, but it turns out to be very, very difficult to service that. So angel investor and VCs, you have to be very careful before committing to them at any stage because after that money is given to you, you need to give lot of performance, lot of reporting. You have to go for a lot of policy and procedural issues, which probably you will feel that your management controls are going out of system. The commercial loan and revenue-based funding is generally done by most of the NBFCs, banks, and public sector banks. Most of the public sector banks may fund you or based on your future projections. These projections is generally decided by you, and then they will only check whether it is viable or not. Most of the time, I have seen that the projection given by the entrepreneur is very, very optimistic and aggressive. Bank may sanction the loans with those aggressive projections, but when it comes for disbursement at a different stages, they will always check what is happening and what you have committed at the time of giving projections and what the actual it is. Based on that, they may stop or they may reduce the next round of payment. That may affect your business. So while taking a commercial loan based on projection, you should check your projections very thoroughly. It should be realistic. It should not be inflated. And at the same time, there are banks which funds based on your past track record, your past revenue, your past business, your past growth. So that is, we call it revenue-based funding or a track record-based funding. So that at the time of expansion, at the time of specific deals, those kind of details needs to be checked. Here in this case, those banks who give you on a past revenue, they sometimes the only problem which Indian entrepreneur faces, their financials are not strong. Basically, most of the Indian financials, entrepreneurs are trying to avoid tax and profit as much as possible. They may be using a Mercedes but showing a net profit of 5, 7, 10 lakhs of rupees a year. And they find the ways not to pay tax. In those cases, it is very, very difficult for a revenue-based or a track record-based financer to fund. So when you are planning an expansion, you need to show the reality. You should have a realistic things. And when you're making money, if you pay tax, no harm in it. Because most of the systems are going towards the after GST and after new tax regimes. If you are clear, you'll have always a better performance and better support from the system. When you decide for a borrowing or you decide to go for an expansion, there are certain government programs which are there where you can get the government incentives or government subsidy if you borrow through a specific source. So there are certain institutions which are associated with those programs. And if you go and borrow from those institutions, slightly you may have a higher cost while borrowing, but overall you may get a subsidy, you may get an interest subsidy. So end of the day, you get a better rated funds. Most of the time, what happens is the entrepreneur only goes to a specific known bank or a known person. They do not evaluate with certain other institutions which are specifically for those work. So the institution like SIDB, where people should go and understand possibility for their expansion support through those where you can get government subsidies. Now, the supplier based or debt financing. Supplier based financing is basically generally what we have seen is in a very large organization where they have got a negotiation power. So let's say a company like Reliance and all, when you are a supplier to them, you have to follow a 90-day or a 120-day credit terms, and then you have to supply the material. They may make the payment on a 120th day, but that is the amount which you have financed their business. And when they supply to their customer, probably it is on advance or it is on payment against material. That means, let's say you have supplied a every supplier to a Reliance supplies them every 90 days, and Reliance supplies material with 30-day advance, means 120 day of working capital is funded through suppliers and customers, but not by on cost. So that is the way of funding. So many times, if you are buying from some supplier and you have a monopolistic capacity, in those cases, you can ask him to supply at a specific credit. That means you keep on enjoying that money without any cost. But there is a risk to it. If you are not having that monopolistic purchase thing, then probably they may charge you higher and you will not realize that they may charge you 1.5% higher compared to you can borrow at 12%. So you are anyway using 6% by using this. So supplier-based financing is only useful when you do not have a supporting to borrow, but you still get a supplier's credit, then you can slightly utilize this. Same times commercial paper or a trade credit, sometimes government or a bigger organization issues a commercial paper against which they borrow. And because of their market reputation and no securities are given against that. Let's say if that happens, let's say sometimes they go and borrow on a demand, some organization go and borrow against a demand promissory note also. So probably that kind of borrowing is only available for a medium and a large scale organization compared to a small and medium entrepreneurs. Because most of the smaller entrepreneurs, the sources available to them will be the bank, friends and families. And if you have a brilliant, innovative idea, you can go to a angel investor or somebody like that. Sometimes in supplier-based financing, we can talk to our customers where we can give minor discount for early payment. If that happens, we can manage our cash flow. So we need not borrow for, let's say, Diwali time and all. We are thinking of higher business. We can talk to a customer for slight discounts and take an early payment from them. That means you can manage your working capital. So if you have to do for a specific demand or a specific time period of funding only, you can go for this kind of supplier financing system. Yeah, Vishal, can we have a next poll before we go to an next slide?
Yeah, so that was so interesting session, and I think you brought up very good points. So just out of curiosity, I just wanted to sound something. Most of the times, as you have explained, that angel investors, VCs type of working and bank loans and personal and family. So Prasanna has already launched the poll, so you can please fill up the poll. I will continue with my point. So most of the times at an early stage of business, the entrepreneur takes the highest risk and he needs some like-minded people to take the risk with him. In that case, most of the times they look up to angel investors and VCs, and many a times, sometimes people are more comfortable with equity investment than loan or debt because they think that equity is not to be repaid. So there is a notion, Sunish, that equity is preferred over debt, but to my mind, equity is the most expensive source of finance. So what do you say by the time people are taking the poll?
See, equity is actually the most costliest source of finance. The reason is in debt, your fixed interest is you know what you have to pay. But in equity, it is not so. Let's say there are two cases which happens. One, when you part the equity, you lose the freedom, you lose the control, and that may cost you a lot over a period of time. The second is, let's say you got the valuation, and then angel investor would have come at 10, 15, 20 rupees premium to start with. Maybe not, maybe at a fixed price or a face value also. And then you must have given for 1 crore of rupee or 2 crore of rupee, 20, 30, 40% of your stake of your company, because you wanted that money at that. And then your company has grown and you go for an equity where angel investor will make is 20 rupees or 300 rupees or a 400 rupees. But you will realize that whatever you have given for, let's say, a free money is actually a valued so much. You may not make money, but somebody else may have made money. So what I suggest is every stage we have to evaluate and then decide. Sometimes equity investment after certain level of business may be good. It's like, let's say you have all utilized your resources and growth and fuel the growth for your company. Now the next level of growth is the next jump where probably your personal resources are not enough. And you still need to grow. Let's say you need to expand worldwide, or you need to have bigger factories, and your all funds are locked in the current business. And then you take out some equity and give it to somebody for huge money.
Right.
Okay, where you have got some premium. Then I also take it that, okay, with that money, let's say you doubled your business. So you were not going to double your business because you did not have money. But with somebody's 30, 40%, so he invested and you made money, so he made money. But
Right.
in angel investor, what happens is you always give equity very cheap, because you do not have that negotiation power. You are very desperate for the fund, because when you go to an angel investor, means it's a starting, it's an idea, you believe it in it, and nobody else will fund you for that because you do not have a track record. So you just give it at a discount. But
Right.
once you are at a half the way of your life, or basically halfway of your growth, then you part equity, you get some premium, and based on that money, you can fuel into a more successful thing.
So it can be your booster basically, instead of your first
Correct.
year or second year, right? And I think we all have witnessed it, like in IPOs, most of the IPOs of these startups, who were invested by fancy VCs. They were actually not the IPOs; they were mostly all the offer for sale. And most of these early stage investors have made a lot of money, and retail investors have lost, bleeded heavily. So yeah, that is like that. So we have got the poll results. So out of attendees have suggested that they look up to 40% look up to personal, family, friends type of sources. 80% use bank or SPA as a source of funds. 20% angel investors and VCs, and 20% for IPO and private equity. So that's interesting. So yeah, we can move to the next part, Sunish. I will pull out the slide for the same.
Okay. Crowdfunding is not very, very popular in India, but crowdfunding, what I'll say is a project or a business is funded by a small investment by from a multiple people. There are certain crowdfunding platform available here where you have to come out with an idea and business and the requirement. So you have to prepare your case. Based on that crowdfunding platform will market your idea to a lot of investors who may take small risk. See, in angel investor, generally an investor takes a huge risk. So he may be investing into 50 companies like new startups, and out of it, 2 or 3 may give you brilliant results. 10, 12 give you a mediocre results, and there are few in business which may fail also. So that's a risk is huge from the angel investors' point of view. Whereas in a crowdfunding platform, you still get a huge money, but it is coming through a multiple source. The only benefit of that is you need to there will be probably no direct involvement of those investors into your business. You need to be very transparent in your reporting system, and when you do that, and when you start performing with the transparent reporting, probably there are 4 different kind of crowdfunding is available. One is equity, one is debt, and sometimes for some project it may be a donation also. It is not very common here, but for some charity projects and all which you want to run, people go for these kind of crowdfunding things. Corporate sponsorship. Sometimes when you are into a business where you are supplying to specific corporate, they may ask and come to you and say, we are working on specific project. You invest into that project also by having these kind of facilities in your company. Like example, Tata Motors came to Sanand. So most of their suppliers were asked to come to Sanand. In that process, it is not always that you only have to invest everything. When you have a dedicated customer and you are designing things for him, he may come and support you by giving some kind of funds to develop new things and some kind of commitment. So if you have a product tie-up supply, you can utilize these kind of negotiating things that, okay, you want the next generation to be done, you invest in my plant for this much and commit me this much. Because every time when you go for some kind of expansion, you should have some kind of surety of business or some kind of commitment of, so you can go for a corporate sponsorship. Many a times these kind of things happens in the IT industry where your vendor will come back to you and say, you develop into this infrastructure because the kind of next generation capacity which I require, I will be requiring these kind of specific things, so that you can take those kind of projects by your customer investing into it, and some kind of corporate sponsorship for this. Basically, grant, the competition, what I'll not take it, grant. Government has a lot of programs under Make in India or under Atmanirbhar Bharat or they where you need to evaluate your business whether it comes into that or not. Like MSME loans is not basically a grant, but it's a government supported program at a lower rate of interest. Or a CGTMSE loan where it's a government supported loan program for the people who do not have the security, but they have a business, they want to develop a business and they want funds. Bank always wants a security for their money. They always want interest and the money should be secure. So the government of India has come up with a scheme called CGTMSE where you have to take a credit guarantee insurance. So in case of your default, the insurance company pays for your default. Doesn't mean that you can take that money and default, because there are mechanisms whereby they will collect money from you. But that only happens to few cases, because most of the cases, I believe that when they take fund and which is not available from any source, they are always true and transparent in repayment, because they want to grow with that fund. Then that's the only available source. Only people where the credit is available freely or very fast or at a fingertip, then there are chances that they may default. But this is a government grant where because of the insurance, banks are secure and you get your funds. So these are the basic things which are there. Then there are certain NBFCs which gives or banks also which gives unsecured loan. These unsecured loans are very costly, but sometimes in a requirement we propose the customer to go for it, because what happens is your payment, let's say your payment is stuck up in some organization and you still need to manage your business transaction, and you have already borrowed from every source of fund. Then that money which is delayed is not gone, is going to come back. So you need to keep your reputation also. Then and then you should go for these kind of unsecured loan where you pay higher interest, but just to prevent the accident of default or to prevent the market reputation that, okay, this guy is not paying me because his money is stuck up. But you need to manage your cycle. Then you should go for these kind of alternative source of funding. Bootstrapping is generally a concept with a startup where most of the startup starting with their own fund. When they start with their own fund and do not borrow from anybody outside, then there are ways to generate funds from their own system, either by cutting cost, or sometimes when you decide to start a lot of things together, you do it step by step so that you can utilize your own fund and make the best use of your own fund. So this is how basically multiple ways you can borrow fund, but there are banks, NBFCs, nationalized banks, they have got different process and policies to suit every industry requirement. Sometimes when you talk to a bank or an NBFC for your industry, and they say, okay, no, we are not funding in this industry, or we have got this restriction in the industry, that means you will come to know the risk factor you also may face over a period of time. I'll give you an example. I was talking to a banker for a distributor of a mobile phone who requires 10 crores fund every month for his supplier's credit. So 120 crore transaction possibility and 40 crore of loan because 4 months was a payment period. They've clearly said we are not funding these kind of things in a mobile industry. The reason is the technology gets upgraded very fast and those things which are in stock suddenly devalues. So it's a very, very risky thing for a banker. Whereas in certain industry where stock is good, stock value never depreciate, they have a good system of doing it. So if you are planning some kind of project in those kind of area, you will get an idea. So when you decide to borrow, generally the people are shy to say that we are going to borrow. You should be open and clear and discuss with multiple people. Let's say, even if you borrow from your friends and family, I will say don't borrow from one person. Borrow from multiple people in small quantity. So even if somebody asks for a repayment, you can still manage it. Generally, the concept behind borrowing from friends and family is people will say, सबको नहीं बताना, एक को बात में हो जाता है तो क्या फर्क पड़ता है? But in that situation, you put yourself in a next risk, probably sometimes down the line. So when you borrow from a bank, one more thing we should always think is, let's say you require 1 crore of rupee, plan for 1.1. You should always have a contingency. If something goes overrun, then you have that institution to support you. But if you go, let's say you require 1 crore of rupee and you decide 90 lakhs, and then you decide I'll borrow at the next stage when I require that 10. Sometimes the bank will not give you, and bank will not let you take from somebody else. That means you are stuck up. So in those situations which have come in 2008, 2010, with most of the developers, builders, where their project was at 75, 80, 90%, the customers were demanding the delivery. The bankers were saying, you complete this stage, then and then we will fund. Home loan companies have already funded, so they are following. And you have already utilized whatever fund you have. And your 10% work is pending and nobody is giving you money. That means you delay the delivery, your reputation goes down, and your next project suffers. But if they have planned for 110 and not withdrawn the remaining 10, that would be okay. So when you plan, you understand your stage, you understand your industry, you understand the competition. You never borrow and decide to burn that I will capture the market and then I will rule the market. There is somebody else who's gone to the next stage who will counter your strategy, and you may have to either prolong your marketing burning, or you may have to borrow, or you may have to stop burning and start taking losses. So my is, whenever you decide to borrow, you always think from a scientific way, how much I need, why I need, Will it suit my requirement? And what is my contingency plan?
Right. Well said.
That's all from
Yeah,
that's
well
all
said.
from my side, Isha.
Yeah, so we are very much on time actually. So what I suggest, Prasanna, is please launch the poll, and meanwhile, you can, if you have put a note on your question, please raise your hand. We can activate your mic, and we can answer your question. So as we see on the screen, 67% of the attendees, look up to bootstrapping and peer-to-peer lending, most of them. Some have tried crowdfunding. I don't know what way, but yes. So if you have any questions, please raise your hand. In Zoom, you can click on participants or on your own name, and just click on three dots, and where you can raise your hand, and we can activate your microphone, and we can answer your question. So I think, Prasanna, please conclude the session. I think if we have any question, we'll take it up. So thank you very much, Sunish. It was very, very insightful session, and we look forward to many more from you as a finance buddy of United SMEs. Yeah, Prasanna, over to you.
Thank you, sir. Thank you, Sunish, sir, for such a detailed and knowledgeable session. This session do leave us all with plenty of ideas, information, and vision to reflect upon. On behalf of Fund Flow and United SMEs team, I thank everyone for attending this session today. Please fill the survey form which you will get at the end of the session to give us your valuable feedback. Thank you again.
Yeah, Prasanna, one more thing. Please check the question from Mr. Mahendra. I mean, he requires a phone number. So, can you share, Sunish, with your permission, can we share a number, your office number?
Yeah, you can share my number, not a problem.
Yeah. So,
and you can also share Mr. Mahendra's number if I'll also talk to him.
Right. So, Prasanna, can you, put it in the chat, so in case somebody wants to get in touch with Sunish, they can freely do it. Can you please put it in the
Yes,
chat,
sir.
please?
I'm just doing that.
Yeah. So, Mr. Vaman, we have the phone number of Mr. Sunish Shah in the chat. So, thank you very much. I think, yeah, there is no question. So, thank you very much, Sunish, again, and we look forward to many more from you. Thank you very much.
Thank you. Thank you.